Unity Software stock price dropped over 15.8% today after the company reported earnings. We can see the stock is sitting at $31.83 with a market cap of roughly $12.8 billion. So in today's episode, I want to take a closer look at 3 reasons why the stock price dropped so much after earnings. And I also want to explain that even though I believe the price action is correct at the moment, I am still bullish in the company in the long term of things. So let's take a closer look in today's episode. So in my opinion, there are 3 things that investors are really hating about Unity right now. And the first one I want to say is the complete dilution of shares. Here we can see fully diluted shares outstanding details, and we can see in Q1 it was roughly 345 million shares. Sitting here in Q4, we're sitting at 474 million. The company did announce a few convertible notes and also an acquisition deal that has kind of boosted those shares outstanding. And we can see for the estimated year of 2023 that is expected to increase to 493 million shares. So it is pretty crazy how much this company is diluting their shares. They do mention that this forecast of 493 million does not include any form of share buyback. And during the fourth quarter, they did mention that they used roughly $1.5 billion as part of their $2.5 billion share buyback program. So we can see even with this huge buyback that they did this quarter, the company is still diluting shares like heavy. I mean, as we take a closer look in this slide, we can see stock-based compensation has grown over 50% versus 2021. On the bright side, and unfortunately it is coming at a cost with a lot of workers laying off, it does seem like Unity is really focused. And again, I do believe this is mainly due to the overall macroeconomics. All these growth stocks have to focus right now in reducing those expenses. So Unity is laying off workers. They are kind of reducing other expenses to become profitable and stop this dilution at least a bit. So the second thing I believe Unity investors might not be too excited about is the overall destruction of the company's balance sheet. We can see in 2021, the company had roughly $1.7 billion in cash and cash equivalents and short-term investments, and roughly had a 1-to-1 ratio on convertible notes. The situation has changed now where the company now is sitting at roughly $1.4 billion in cash and roughly $100 million in short-term investments. So roughly $1.6 billion if you round up versus long-term debt of roughly $2.7 billion. So again, this is not what you want to see with a company that's increasing that stock-based comp, that is using huge amount of stock-based compensation, that is diluting shares like crazy, and unfortunately is at a crazy downturn in the macro of things where the advertisement market is taking a huge hit. So I do want to say the second thing is this kind of destruction or this weakening of the overall balance sheet. At the end of the day, the company does have plenty of cash of roughly $1.6 billion, where I don't believe it's anything too crazy, where I don't see this company going under. But what I do hate is that, hey, in 2020, this is a company that had barely any debt, and just now focusing in 2022, it's almost a one. I believe it is a 1.5 to 1 ratio of debt to cash. So that is something that I do believe investors need to keep a closer eye on. I mean, continuing in the financial sheet, if we see the company's cash flow, we can see they use roughly $50 million in operating activities. So even cash flow from operations is not positive, even though they have this huge kind of stock-based compensation expense put back in, since it's not a cash effect. So again, this is back to point number 1, where, hey, the company's kind of really diluting its shares due to the overall expense the company is seeing. The second thing is that destruction of the balance sheet. Before we go any further, I want to thank you for watching, and I need your help to reach my goal of 30,000 subscribers by the end of the year. So if you can do me a favor, hit that subscribe button and thumbs up. Also, if you want some fantastic insight into the semiconductor industry, join my other channel, Semiconductor Investing and More, where I use my electrical engineering background to break down the semiconductor market. Finally, I want to thank The Motley Fool for sponsoring this video. and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for their subscription service. Now, let's continue with today's episode. So now if we take a closer look at point number 3, I want to say that this company, unfortunately, is going to have a weak year as well. And you might be like, Jose, how is this company going to have a weak year if they expect full year revenue to be $2.05 to $2.2 billion, up 47 to 58%? How can you say that? This company is growing dramatically. And this is true, right? They are growing at a strong double digits, but this is thanks to their Iron Source acquisition. If we take a closer look, they actually even give us some great information on what that revenue was in the full year of 2022 with their combined financials. So combined financials of 2022, company's total revenue would be roughly $2 billion. So from $2 billion is growing to roughly on the top end, 2.2. That's only about a 10% year-over-year growth if you do account for the acquisition. Explain why, even with this, I'm still bullish in the company, but we can see things are not as great as sometimes you might see in their guidance. For example, the first quarter of this year, they expect $470 and $480 million, up 47 to 50% year over year. And you might look at that and be like, wow, that is amazing. But if you take a closer look at how their financials look together, quarter one of 2022 was $510 million. So in a combined form, they're actually decreasing in revenue. The main reason, though, is quarter one, they still had a very strong growth solution. That is the advertisement market. And right now, we are still seeing a weakening in that space. So I do believe guidance was super weak, and unfortunately is because of the macroeconomic and that headwinds that we're seeing in the advertisement space. The company did mention, I do believe I have it highlight, that while they are not forecasting a recovery in game ads market in 2023, they believe it is possible when the economy improves. Right now, they are being very conservative with their guidance, and they're pretty much not forecasting any recovery at all in the ad space. So again, I do believe it shows that they're maybe being a little bit too much conservative. But in the earnings call, the CEO and the CFO mentioned that the main reason they are focusing like this or having a forecast with no recovery is because it makes them focus mainly on profitability and not too much on growthness, and having the growth being the reason that they become profitable in the future. So it's an interesting take. I can definitely see that take. And again, they do mention that right now, most of the economies are soft and some are in a recession. So some of you might be wondering, Jose, if you have all these negative reasons for Unity, why don't you sell? So first, I do believe, yes, these are true red flags or yellow flags, however you want to see it, for the company. But this company sitting near a $10 billion valuation, to me, I believe this is still a growth opportunity in the long term of things. I did a video on November 11th, why Unity Software could be the best growth stock to buy now. At that point, the stock was sitting at roughly $20-something. It was when the stock took a huge hit after, it was around here, November 11th, where the company took a huge hit after their previous earnings. And I said during that earnings call, while this company has a market cap of roughly $10 billion or anywhere near there, I believe that is a huge opportunity, because for all the solutions this company provides, I can easily say I can see some big tech, if the regulators wouldn't prevent it, a big tech purchasing this company easily for $10 billion. So if I see a big tech player being able to purchase at that price, I feel like that to me is a comfortable level for me to continue to buy at those levels. So for me, again, right now, this year is not going to be the best year for Unity. We see right now that all these kind of macroeconomics are definitely affecting it. So when I see the stock price go from, we can see year to date, the stock is up over 18%. And we can see if we take a look from its year to date high, it's actually up 58%. So the stock was pulling up a nice amount. And I don't think much has changed for this company since then. So I do believe this is going to be a company that is going to be quiet in form of stock price for the next few quarters. And I do believe if you are an investor, that's what you should be expecting. I do believe that we won't get too much away from that 10 billion. Even right now with that 12 billion, I think this is where we're going to stay at until something changes. Obviously, those changes could be both on the downside or on the upside. I do believe at these prices, we do have more opportunity in the upside. So let me explain some of those opportunities. First, this is a company that digital twins continues to grow. I mean, they mentioned it in their most recent earnings call here in the presentation that the industries beyond games are up 118% year over year. One of those solutions is this digital twins that they kind of have for industries. The second thing I want to say is Unity is used strongly for machine learning agents and artificial intelligence, for robotics, for automotive, and so much more. So this is an opportunity that they can continue to grow. I did a previous video a few days ago where it was the top 5 companies that can benefit from AI. The AI executive for Unity mentioned that companies like ChatGPT, OpenAI are using Unity for AI solutions. So again, there's huge growth space here. The next thing is the advertisement market, right? Even though the advertisement market might still be weak right now, this is something that's gonna come back. And when it comes back, it's gonna be strong. And this Unity and Iron Source acquisition will definitely lead the charge in the game ad space. Finally, I have to say that real-time 3D is going to continue to grow in numerous markets, not just in gaming, not just in digital twin, and so many other solutions like automotive, like constructions, that I do believe I'm okay personally. And again, right, every investor is different. I'm okay with this company sitting and being quiet. I do believe the stock price will be very volatile. This is a high beta stock. But I don't, if you look at the average, I don't think we're going to move too much from this market cap of 10 to $12 billion until something changes. And I'm okay with that because as a long-term investor, I do believe there is plenty of tailwinds for this company. Again, that doesn't mean I'm blinded by some of those risks. We saw that stock-based compensation. We saw that destruction of the balance sheet. We see the weakness or the weak forecast that they give. And a lot of that growth is due to the acquisition of Iron Source. Even with those risks, I am personally, I see them, right? I understand them, and I'm personally going, okay, I understand those risks, but I do believe there's still potential in this company for all the solutions that it does, especially at this market cap. So let me know in the comments below, what do you guys think of the overall stock price reaction? Like I mentioned, 15.9% down is a lot, but we're still sitting at a higher price than the previous earnings call.